Well, greetings, sailors. It's been a while since my last webinar, and I wanted to get together with you to go over one of the most sought after topics that we get requests for, and it's the tax implications for U.S. citizens buying a boat and placing it into a charter fleet. So there's much of this information can be found through various sources, through CPAs, but I've been working very closely with Gary McKinley, a top wealth manager for nearly a decade. And Gary has put together a team of professionals who go really beyond the simple CPA issues. This team, Tideline Solutions, encompasses the bigger picture of how yacht ownership can fit into your portfolio more generally. And I always like to talk about Gary and how I am sure he wakes up in the middle of the night with new ideas about how to turbocharge the investment in a yacht. Gary has been working with wealthy and ultra wealthy individuals, really helping them plan their portfolios. And today, I'm glad Gary was able to join. We weren't sure until the last moment, but also Gary's son, Joe McKinley, and the top CPA from Tideline Solutions, Doug Benefield. And I'd like to come away with some general information on the guidelines to help structure your investment in a yacht and have some time for you to ask specific questions. So pull out your pencils and jot down any questions that you may have. This is really the meat and potatoes comes when we get really good questions from people like you. So there is a chat button. You're able to add some questions on the chat button. But without further ado, I'd like to introduce Gary, Doug, and Joe. Gentlemen, thank you for your time today to help demystify the tax benefits of purchasing a yacht to place in a charter fleet. Can you tell us a little more about Tideline Solutions?
Thanks, Philip. Well, I'm Doug Benefield. I'm a CPA. My partners are Gary and Joe McKinley. We're based out of Northeast Florida. My day job is a regular CPA with a CPA firm, but we found a little niche, a little specialty in these boats, and specifically sailing boats. A lot of boring reading, tax court cases, IRS cases, people that lost when they wrote off their boat, people that won that wrote off their boat. And we developed a little system to help you as a boat owner write off your boat. And happy to be here. I'd much rather be in Annapolis than sitting in front of this computer screen, or Miami, Palm Beach. Joe McKinley.
Yeah, so me and my father have a registered investment advisory where we specialize in tax on the investment side of the world. So different assets like real estate, energy, private equity, private debt. Yachting has found its little sliver inside the allocation and inside the strategic investment strategies we use. So happy to be here. The three of us are all fiduciaries by job description and by profession, and excited to kind of show you guys how owning a yacht can be a good part of the portfolio, or at least not a completely horrible investment through these strategies that we use.
Thanks, Joe. And I see some familiar names as participants. One specifically in Texas that's got an island spirit coming. But it kind of leads into who the ideal client is that would buy a boat. What we figured out over the 5 years we've been doing it post-COVID. Most clients fall into kind of specific categories when it comes to who wants to buy a boat and who's the right person. We have clients with big W-2s. Maybe they're getting a bunch of stock options. Maybe they own a business. The business produces a bunch of income. These are pretty easy. When it comes to buying a boat, we can eliminate a huge chunk of that income, save the taxes, and there's one thing for sure. If you write a check to the IRS, they're going to spend it for you. We'd rather keep it in our pockets. Second category, maybe it's that business owner that's built a successful business over 10, 15 years, and it's time to exit, it's time to sell, but we don't want to give all that money to the government, and we want to spend some time on a boat. Let's use this new boat to offset the income from the sale of a business. Joe, do you want to talk about economical boat ownership?
Yeah, we have a lot of customers who are really just looking for the most affordable way to, whether it's vacation or own the asset. So maybe buying a boat and having it sit somewhere 10 months out of the year or 11 months out of the year unused, with the dockage fees and the maintenance and everything else that goes into it, isn't something that fits in their budget. And so Philip and his team can help you own the asset and also help you partner with cash flowing charter partners who will basically make boat ownership affordable and potentially even profitable. And the last one is really the dreamers. So we have plenty of people that this has been a 2 or 3 year process, and some even longer, where they work right now and they have a dream of retiring and sailing around for 6 to 12 months out of the year. And they're going through the process of learning how to sail, taking the vacations, understanding where they want to be sailing. And through that process, they can actually look to buy a boat now, have it cash flow, have some of the debt they potentially may have on the boat get paid down while they're still working full time, and time it so that when they do retire, they have a boat that has, in a lot of ways, paid for itself over the years, available to them, while they've also become an expert at sailing, on the vacations they've taken in the meantime. So many different type of clients that are able to utilize this into their lifestyle and into their financial balance sheet and profit and loss statements as an individual.
Yeah, if I could add to that, Joe, the dream today, by the founder of Tesla and the founder of Uber, was that all of us are going to have cars in our garage, which, when we're not using them, we'll be out in an Uber-like fashion making income for us while at home and not using them. And there's a dream that many of us entrepreneurs have, that all of your assets are working for you, creating income. So this fits right into that box.
Yeah, thanks so much. I think most of the people watching this webinar, either live or recorded, have heard about the benefits of accelerated depreciation. Can you give us a little rundown on how this works?
Sure. Let's take a step through this with some simple numbers. We'll do a 2-year tax projection. We're going to lay it out first without a boat. So this would be our standard projection. For ease of calculation, let's say you have income of $1 million. That could be on a W-2, it could be on a K-1. What we're finding more and more is that those close to retirement have large qualified plans. So IRAs or 401ks, we actually produce a lot of kind of artificial income by getting that cash out of an IRA situation and using the boat. But for simple terms, we'll call it the 37% tax rate to the IRS. You make $1 million, we're going to pay about $370 in taxes. Over 2 years, that turns into $740,000 of taxes. You get access to you get $1 million on a W-2, those taxes go to the government. You get $1 million on an IRA, they go to the government. You're left with the remainder. So let's play it the other way. Let's say you buy a boat. We're going to say purchase price of $1 million because that makes life easy. Got $1 million boat, $1 million of income. First year, most standard situation, we're going to generate $1 million in losses. And the number in front of you is 626. We've got some limitations we have to deal with. They don't apply to everyone, but most commonly we're going to be able to use $626,000 of that $1 million boat purchase price. That takes your adjusted gross income down to 374, and the taxes on that are roughly 140. The kind of the beauty of where this falls, we've taken $1 million of income down to 375. We've eliminated all of the income in the 37% tax bracket, and I want to say most of it in the 35% tax bracket. We haven't taken it all the way down to 0, which is actually going to turn out to be nice. Year 2, we've got the remainder, that 374 of losses generated. $1 million boat, we've generated $1 million in losses. We've used that $1 million in losses over 2 years. Year 2's income goes down to 626. We do end up paying some taxes here, 232. But let's see, how do I click it? Total taxes in the timeline, $1 million boat projection, 371. We've saved $370,000 in taxes. Those are even numbers. It's just as simple as math as we can do it, really, in this kind of format. But we've cut your tax bill in half, and now you have a boat. Philip, what are we looking at for down payment on boats these days?
The most typical is 20%. There are a couple of banks that are asking for 25 or 30%. The rates get better if you are going to borrow. Then it's typically 20%. That's the most common.
So we've generated $370,000 in tax savings. Just in the first year, you've covered your down payment. The second year of tax savings, you're basically putting it in your pocket.
What are the interest rates you're seeing right now, Philip?
We're seeing right around 7%. Interestingly, one of our lenders has a 0.25% reduction for electric boats, and one of my 3 big sailing passions, getting kids out sailing. As a matter of fact, my son is sailing across the Pacific Ocean right now. He raced the Transpac, and he's halfway back, bringing the boat back with a few friends. But getting kids out sailing, getting people crossing oceans, and then finally getting sustainable boats on the water. So I've really been focusing on sustainable boats, and it's good to see that there's an extra reduction in interest rates for all electric boats.
Philip, that's funny. What I learned when on my last trip is that you don't run your generators at night when you're in the port next to all the boats. Apparently that's very, very rude.
Yeah, well, that's really one of the benefits of the electric boats. And this is a great tax savings. How does it look on the cash flow?
Well, I'm glad you asked. we're going to run through the same kind of simple projection with dollars in your pocket. Situation number one, you write a check to the IRS for something like $370. Cash flow into your pocket is $630,000 in year one. Same situation exists in year two. Total cash flow into your pocket is 1.3. That's out of $2 million of income. It is what it is. The IRS is not going away despite what we were hearing before the election. It still exists. I'm totally conflicted on it, but I'm thankful to still have a job. Here's where that down payment comes into play. So $1 million boat, 20% down is $200,000 out of your pocket. And we do end up paying some tax year one. So net cash flow is $661. We're to the positive cash flow, $31,000, rough numbers, on day one of buying the boat. But you've got 20% of that boat paid for. Year two, we've got additional losses. We generally set our cash flow for the boat as a business to be cash flow break even. So that's principal, interest, depreciation, all the charter fees and everything. We'd like to see you cash flow break even on the boat, and we're going to show losses on paper for the tax return. So cash flow into your pocket year two is $768. $1,429,000 is total cash flow over 2 years. So you're $169,000 positive after buying a boat, which it was, we worked these numbers a bunch of different ways, and it's pretty amazing.
Yeah. So we have a lot of owners that are not bringing in $1 million a year. What do the numbers look like at, say, $500,000 a year?
They're still beneficial, but we might not actually use this bonus depreciation. So bonus depreciation is the one we love. A lot of the articles online are going to talk about 179 expense, which is a separate code of depreciation. But the truth is 179 expense depreciation cannot cause a loss. We'd rather cause a loss using the bonus depreciation. But let's say we don't have the income. And we run through this in our tax analysis with prospective boat buyers. We have a couple of levers of depreciation available. We might choose not to use all that loss in the first year, and we typically pick up 20% of the purchase price as a first year deduction. So that'd be $200,000 of losses. So you're talking income of $500 that we've reduced down to $300. Tax savings is probably somewhere in the $67,000 range, $70,000 tax savings. But that's exactly what Joe and I do, is we sit down and we look at real numbers and real tax returns and real boat prices, pro formas from the charter broker. How do we expect the boat to perform? And we cash flow it out.
Yeah, there's that's an interesting statement. You work with buyers, you help them really look at all of the aspects. There is more than just the tax side of placing a boat in charter. There's the setup of the legal entity. There's of course, the initial tax planning. There's the business plan, the accounting for the business, etc. And I understand that you can do basically all of that. You have people you work with that can build the websites. What's the common recommendation for a legal entity for the business, and can you handle setting that up?
Yes, and we'll dig into that in just a second. On the front end, we typically want to meet with the prospective boat buyer. That's the analysis. That's where we do the tax savings calculation. We look at what your income is going to be the year the boat shows up. We look at what your income is going to be the next year. So we're potentially looking at 2026, 2027, because ultimately we're analyzing how to best use this depreciation for the benefit of tax savings. Typically that involves getting copies of tax returns, personal financial statements. And I'll tell you what's important about this. That person that might have $500,000 of income, there might be a couple $1,000,000 in an IRA. We might use that boat depreciation to get the cash out of the IRA environment into a spot where you have access to it.
That's very interesting. Well, I want to address that maybe as a separate point, but yeah. So after the analysis, what do you do?
It typically takes, I don't know, Joe, 3 meetings. Initial meeting, what boat do you want to buy? Why do you want to buy a boat? Where do you live? Who are you? Kids, grandkids? Where have you sailed? Then we collect documents, tax returns and personal financials, investments information. Joe and I will come back, dig into the tax software, and basically produce a report.
Yeah, this is where the fiduciary holistic planning process comes into play. So generally, we will provide a very accurate tax projection. But for a lot of our clients, they're looking for, how does this fit into our overall financial planning? How should I pay for this boat? Do I take money out of a retirement account? Do I pay in cash? Do I borrow from a stock portfolio? Do I borrow from a piece of property I may have? And really looking at what else can be done inside your plan to make this the most efficient or effective, while also mitigating any risk that bringing in an asset of this size may provide in the portfolio overall. And so there's a lot of great strategies that you can implement when you have $1 million of losses available to you. A quick example is we had one client who was retired. He retired early, maybe late mid-50s, and had a large sum of money in his retirement account. He didn't need income. He didn't produce any income on paper. And so there was nothing to use the losses against that was happening naturally, meaning he wasn't collecting a W-2 and didn't have a business paying him income. And so what we did is we took $1.5 million over 3 years out of his IRA and put it into a Roth IRA or a brokerage account. We split between the two. And by doing this over a multi-year process, he had no tax consequence on that money leaving the qualified retirement status. So for him, it was a huge success. It was, $1.5 million where he would have owed $300,000, $400,000, $500,000 in taxes that he didn't have to pay. And now his money can grow tax-free or be in a capital gains growth tax state from there. So there's a lot of holistic, big picture things that we like to take into account when we're working with individuals, because everybody's situation is different.
We the client Joe's talking about is in California, and we got so granular on his income. We actually produced the perfect amount of income so that he's still qualified for the medical insurance that he wanted to. So we don't want him to be at the very low end where it's not really the greatest insurance. We don't want him to be too high where he has to pay for it. We were within a $20,000 sliver of, this is the perfect spot for you. There's no income tax. The insurance is taken care of. It's beautiful.
Let me know when he needs the next boat.
We will.
We may have a slide on this later, but we've gone through the analysis. We've shown you what the tax savings are. We've looked at your cash flow. We've planned out 2 or 3 years. We've presented. Now you buy the boat, and the boat gets delivered, or the boat is coming out of the factory. Before the boat comes out of the factory, we'd like you to set up your legal entity. We like Florida. There's a bunch of different asset protection and business friendly laws in Florida. I'd say 99% of clients are comfortable with Florida. You might make an argument for Nevada or Wyoming, I think is the other one. But as far as ease of process, affordability from year to year, we like to set up the legal entity in Florida and no state income tax. Step 2, we want to do a business plan. So we've done the tax projection and the cash flow analysis. That's really the first half of the business plan. The second half of the plan is, okay, what does the pro forma look like? What kind of charter performance are we expecting? And we're going to cash flow it out. We want to be able to prove on paper that we think we can make money doing this. This is where the hobby loss rules come in. We want to make an argument that we're running a real business. The third piece, and it doesn't have to be a website. We've got Facebook and social media, Twitter and Instagram. We want your boat to be marketed out to the public beyond the charter broker. We're making an argument to the IRS that you're actively participating in this business. And even though we're deciding to use a charter broker, we think we can do this on our own. So that's the website, social media. We want a presence outside the charter broker. And Philip, correct me if I'm wrong, but most charter brokers will allow you to sell your weeks to people you know, or use your weeks, or you get a referral fee. So there's incentive there to bring in charter guests.
Absolutely. I don't know of any charter operators that don't allow you to put charters on the boat. That certainly helps them out as well.
The fourth piece, yeah, go ahead.
Oh, I was gonna say, yeah, and then the rest is the accounting, the QuickBooks, and the tax filings. But really, to summarize the services we provide, 1 through 4 on the PowerPoint is, can we give you the confidence to say yes or no, this is a good idea? You know, obviously, most people who are buying a boat, they're doing it because they want it. They love boating. There's generally a very emotional side to that purchase demand that you feel. So if we can help you from a financial and on paper make it a good idea, not just an emotional idea, that's what we want to do. We want to build the confidence to say yes or no, I'm doing this. And then the last one is, if you do implement it, we want to hold your hand and make sure that you stay out of trouble, you stay in compliance, that you've checked all the boxes, crossed the T's, dotted the I's, so that if by some circumstance you find yourself having a conversation with an IRS agent, you have all the evidence in front of you that, hey, this is a real business and here's the evidence to support my case. Now, I will say that we have at this point 3-4 dozen boat owning clients, and knock on wood, we have never had an audit from our general setup and through the process that we put our clients through.
And then to be totally honest, a lot of that is elegance and kind of the sophistication of the tax filings and doing things a specific way. For a simple example, I'm not going to put charter or yacht on your tax return. I don't need AI scrubbing your tax return and going, oh, this guy's buying a boat. This must be crazy. But, you know, it's a water transportation vehicle. It's simple little things like that. We're not guaranteed to avoid an audit, but the more that we can do from a tax presentation standpoint to keep the IRS off our back. We're not afraid of the IRS, but you don't want to pay me to deal with them, and you don't want to deal with them.
Yeah, and I gotta say, Philip, you know, and I've got to jump off here in a minute, but you know, just as an example, we had a call from a client, retired surgeon and his wife. They have a very large wealth organization doing their asset management, wealth planning, and a very large CPA firm nationally known. And they reached out to us at Tidelines and said, we're interested in getting Yacht and getting into this space. But our financial advisor and our CPA don't have the foggiest clue where to start. And I said, you know, it's good that you called, and I can attest that Doug and Joe take the time to make sure that everything's dotted as far as I's and T's crossed, to make sure that, you know, again, the risks are all talked about and dealt with clearly, and they do a terrific job. But Philip, I have to drop off. I want to tell you, you've got a great company. Looking forward to seeing you in Annapolis, and guys, keep up the great work.
All right. So you had mentioned the hobby loss rules. What are some of the factors that our owners are going to need to deal with to make sure that they satisfy all of the requirements and not have this as a hobby loss?
We want to prove a profit motive. We want to show on paper that we think we can make money. That's step number one. Even if that means that the boat's paying down the loan and paying off the principal. From an income standpoint, the principal is not deductible because we've already taken the depreciation. We want to be able to show 100 hours annually, either with one person or a husband and wife. If you start adding up boat shows and visiting your boat for a survey and populating your social media, we can come up with 100 hours pretty easily.
Okay, and for those of you just starting out, make sure to start logging your hours, including this webinar. I think this would qualify as one of the hours. I don't think we're scheduled to go half an hour, but looks like we may go a little bit longer. Now, historically, our bigger boats have been returning 8 to 9% per year. What happens if the boat only breaks even or posts a loss for the year? Can the owner claim additional losses?
We can. I mean, hobby loss basically says that for 3 out of the last 5 years, you've turned a profit. It doesn't disqualify us from taking the depreciation losses. It just means we could potentially be held to a higher standard. What we would like to see as your advisors, we'd like to see you making management decisions. So maybe it's with a bad charter broker. Maybe they can't generate enough demand. We would want to see some sort of documentation where we would want you to have that stuff analyzing. Maybe this isn't the right broker. What if I put it with this broker? What if we moved it to a different spot?
Okay, that seems to be important, and I assume there are some red flags for the IRS. Not making money is probably one of those red flags. Are there any other red flags that somebody really needs to look out for? And a good point. Acme Holdings would be a great name for to put on your tax return, as opposed to I've got a shiny new yacht that I use all the time, LLC.
Yes, sailing vessel tax write-off LLC. There's nothing that's really going to disqualify you. It's going to come down to an analysis by an IRS agent potentially. Are you generating revenue? If this boat's sitting in your backyard on the canal and you write it off and you take the depreciation and it never generates revenue, you're probably going to lose in an audit. It's not necessarily Joe and my job to determine what clients' appetite for risk is. It's our job to show you these are the options available. This is what could happen. This is good and bad.
Yeah, most of us have heard that the 100% accelerated depreciation has been locked in permanently for boats placed into service after January 20th, I believe, 2025 in the new tax bill. Anything else in the new bill that can help boat buyers?
It's still generating. The idea behind the big beautiful bill is to generate domestic manufacturing, domestic income, keep money in U.S. taxpayers' pockets.
Yeah. Okay. And the years I've been working with McKinley Wealth Management, I know many of the owners are taking security-backed loans as one option, so that they don't need to come up with any cash either for the down payment or for the entire boat. And you guys always seem to be coming out with really outside the box solutions. You had just mentioned that you were moving money from a qualified IRA into a Roth IRA and having the boat make that affordable. Tell us the nuts and bolts of that.
Yeah, so a lot of people may not know that when you convert money from an IRA to a Roth IRA, there is no limitation on the amount that you're allowed to convert. Meaning that if you had a $2 million IRA and you wanted to move it all over into a Roth, you could do it in one fell swoop. The issue is that as soon as that 2 million of value of stocks, bonds, cash leaves the IRA and enters the Roth, you owe tax on the entire amount and it shows up as ordinary income. So the idea here is, if we're moving out, call it $2 million, and we have a loss from the boat, we can offset that artificial income we've created through money leaving the retirement account. It is, between that process, between the ability to set up lines of credit against a brokerage account, an after-tax stock account, between understanding when the tax savings are going to happen and potentially, telling the company you work for to stop withholding taxes, creating more cash up front now. There's so many little levers that can be pulled to optimize the way in which you're purchasing the boat. Where are the best interest rates? Are we going to do it this way in year one and then reorganize in year two or year three because of a changing environment, because of a changing rate environment? There's never one, perfect scenario. And so Doug and I having seen so many different ways and done so many different analysis, we can really help fine tune and pinpoint what's going to work best for any individual.
Okay. We have owners that place their boats into the charter fleets to earn revenue or for the tax benefits or to take advantage of the generous owner usage time. When the charter term ends, they kind of fall into one of a few categories. My favorite, of course, is those that want to get on their boat and sail around the world. I think Doug was alluding to that. I love that. Others will sell their boats. Times change, and they don't need the boat anymore, or trade in for a new boat. From a tax standpoint, what are the benefits or drawbacks of these options?
Sure, and it comes down to timing. Let's say you want to sail around the world. Does that mean you're going to be on this boat 12 months out of the year? If the answer is yes, technically the rules say we should recognize income on the fair market value of that asset when it's converted to personal use. So it becomes a question of, can we put this with a different charter broker, maybe a more mom and pop or a boutique, where it's going to get some revenue and it's going to get some action, but it also gets you more access to the boat? So that's generally one. The one we like is buy another boat. So let's say you've had a great experience and you've gone 5 to 7 years in a charter and you're ready to upgrade. The income produced from selling the old boat is offset by the depreciation on the new boat. it's two different transactions. It's not necessarily the same as a 1031 exchange. But we have plenty of clients at this point that are upgrading to the next boat they want. A lot of people start with a smaller boat, 42 or 45, and they spend time on it and their kids grow. And 5 years down the road, they're looking at 50 or 52 or 54. We're seeing it every day.
Yeah, by the way, I love that option as well, buying a new boat. I'm really good with that one, so we fully agree. Let's assume that somebody watching this webinar wants to find out more specifics and want to reach out to you. What's the process for that?
Generally, we come into play after they've spoken to somebody like you, Philip. I think that before they really get into the nitty-gritty of how is this going to affect my financial situation, or how is this going to affect my relationship with the IRS, we encourage them to be very firm in considering whether or not boating is something that they want to be, doing or running a business as, or making it a big part of their life. And usually that, happens, that decision gets made when they start looking at boats and having those conversations. So generally, I would say anybody who's seeing this, I would say get in touch with Philip, have that initial conversation, and then when the time is right, come talk to us and we can really put it all on paper and again, get to that point where you feel confident in either moving forward or not moving forward from a financial standpoint.
Okay. Well, great. I again want to ask anybody to pose any questions. We did get a few questions emailed to us, and Sarah asked, let's see, if I go it alone without using a CPA, what are some of the pitfalls that I will run into?
The most common pitfall is you're probably going to put it right on your personal tax return instead of using a pass-through entity. And those types of businesses are the most highly audited areas. And it's exactly what you hear when hobby loss rules come up, or when you hear the IRS is targeting middle America, middle class. They're specifically looking at these businesses that are directly on the personal tax return.
Okay, I couldn't imagine that happening. Somebody not getting professional advice, but there are webinars on or seminars on the docks of the boat shows where it's almost a one solution fits all, and I don't believe it is. So
tax law is complex. Buying a boat's complex.
Mm-hmm.
It behooves you to take the time to get to know the person that you're working with, and it's not a one size fits all. That's for sure.
Yeah. A follow-up question from Sarah also was, I'm not going to have a loan. Do I need to have the LLC formed before I sign a purchase agreement? I can probably answer that one. It doesn't matter. You want to make sure that you are able to assign the purchase agreement. Oftentimes, the purchase comes years before the boat arrives, or could easily be a year or more. So go ahead and take care of that, but you want to make sure that you're able to assign the purchase agreement to the new entity before the purchase is complete and the boat is delivered. And from Tim, do you have a spreadsheet that shows the revenue and expenses of this type of business? I know from my standpoint, absolutely. I share spreadsheets all the time with prospective owners to make sure that they know what they're getting into and have expectations. That's always somewhere where I think it's quite important to start.
And
So
Philip, Steven raised his hand, but I'll follow what you're saying up.
mhm.
We don't generally get in the business of advising clients about charter performance. We're tax and legal experts. You're the charter performance guy. Hopefully that makes sense.
Yes, it does.